Hi, Larry Gaines, PowerCycleTrading.com. Well, we're going to be heading into a brand new earnings season coming up next week. We're beginning a lot of bank earnings, and then it really starts to get a lot of fun and crazy with all the volatility. But when we're going into an earnings season, there are three type of earnings cycle trades. So I wanted to show you those kind of cycle trades to look for, take advantage of during this new earnings season. So the first one is what we call a trend trade into the earnings release. So I'll show you that trade, and then we've got an earnings release trade. This is a non-directional type of trade, so we don't really care the direction. We want either big price spike up or down or volatility collapse to play. And then the third one is a trend post earnings trend trade release. So the first trade here this is an example for CRM. But trade one is typically at 1 to 2 weeks out. You might get a really good trend into the day of earnings release. So here you can see the earnings release date right here. So what will typically happen is you get a trend up. So as price goes up, the delta of the option increases and the price of the option increases. But the other thing that makes the option price increase is the implied volatility. You can see this blue line here. Now, the two components of pricing for an option is time and volatility. So as volatility goes up, that increases the price of an option. So in this kind of situation, you want to buy the option series of the earnings date or announcement. You buy that option series, maybe the calls, and that's going to get the advantage of a potential trend up plus the trend up on the implied volatility. Now, you want to be out of this trade before the earnings release. And then the second trade would be what we call a non-directional earnings trade. So trade two is, hold on one second here. Trade two is a non-directional trade. So you want to get positioned here, and you want to be doing a trade for either a big price spike up or down, as you can see here, or another trade opportunity is to take advantage of the volatility collapse, like you see right here. See the implied volatility collapse. So as you're going into the date of an earnings announcement, there's a lot of uncertainty, so implied volatility goes up. Once the earnings announcement is made, implied volatility collapses. So you can play that by selling volatility, or you might get a big price spike up or down that you can trade also with a non-directional earnings strategy using options. Now the third one is the post-earnings trend trade. So there are a lot of stocks that have a kind of a tendency to then start trending back, either in the direction of the earnings. If they were a positive earnings release, they'll start trending back in that direction, or if it's a negative release, they'll start trending down. So that's the third opportunity. So, when we get into an earnings season, it's a lot of volatility. It can, sidelines traders, but be looking for these types of trades, the three types of cycle trades you can look for. And if you'd like to learn more about how to master these trades, I'll be doing a live earnings workshop this Saturday. And if you'd like to join us, it's going to be a really fantastic workshop on all the different variations of the earning strategies that you can use to take advantage of these high implied volatility stocks for either a price spike or volatility collapse, and some other great strategies as well. So make sure to join us for that. Use the link here on this email, sign up for it, and I hope to see you this Saturday. Good luck trading.